Hello, and welcome to another episode of Financial Market Insights for Traders. I'm Sophia, your host, and I'm excited to walk you through a topic that might sound intimidating at first, but is crucial if you want to be a savvy investor or a trader. Today, we're exploring options and futures, types of financial derivatives that can give you a serious edge in the world of commodities and beyond. Now, I get it. When people hear the word derivatives, many freeze up. It sounds technical, maybe even risky. But today I'm breaking it down in the simplest, clearest way possible. So, if you're trying to understand how to invest in commodities as a beginner, or you're wondering whether gold or stocks make the better investment, or even if you just want to follow what experts are saying on your favorite commodity trading podcast, stick with me. We're unpacking all of it. Let's start with what derivatives are. A derivative is a financial contract whose value is derived from something else. That something else could be a commodity like gold or oil, or it could be an index, a currency pair, or even interest rates. You're not buying the actual commodity up front. Instead, you're making a bet on where its price is heading in the future. That's why we call them derivatives. They derive their value from the underlying asset. Two of the most widely used derivatives are futures and options. Futures are agreements to buy or sell an asset at a predetermined price at a specific time in the future. They are standardized contracts traded on major exchanges like the Chicago Mercantile Exchange or the Intercontinental Exchange. You know exactly what you're agreeing to, how much, what quality, and when the transaction happens. Let's look at a practical example, especially for those of you interested in oil trading. Imagine oil is currently trading at $75 per barrel. You believe prices will rise over the next 3 months. So, you purchase a futures contract that locks in the price of $75. Now, if oil goes up to $85 before the contract expires, you've just made a $10 profit per barrel. And if that contract covers 1,000 barrels, you're looking at a $10,000 gain. But there's a flip side. If the price of oil drops to $65, you're out $10 per barrel, which also means a $10,000 loss on that same contract. Futures are powerful because they let you control a large position with relatively little upfront money, known as margin. But leverage cuts both ways. If prices move against you, you might be required to deposit additional funds, a process known as a margin call. Futures can be incredibly effective tools, but they come with high stakes. That's where options can be more beginner-friendly. An option gives you the right, but not the obligation, to buy or sell the asset at a set price before a certain date. With a call option, your betting prices will rise. With a put option, you're betting they'll fall. The most you can lose with an option is the price you paid for it, which is known as the premium. Now let's use gold as an example. Suppose you want exposure to gold, but aren't ready to buy physical bars or gold ETFs. Instead, you buy a call option that gives you the right to buy gold at $1,900 an ounce. You pay a $50 premium. If gold climbs to $2,000, your option is in the money, and you can either exercise your right to buy it at the lower price or sell the option for a profit. If gold falls below $1,900, you don't have to do anything. You just let the option expire, and your loss is limited to that $50 premium. This limited downside is why many investors prefer options as a way to explore commodities or hedge risk. Options can also be used in more complex strategies like spreads, where you buy one option and sell another to limit both your risk and your reward, or straddles, which allow you to profit from large price movements in either direction. While these strategies are more advanced, the core idea is still about using leverage and control wisely. Now, why are futures and options so common in the commodity world? Physical commodities are not easy to handle. Think about it. You can't just buy and store 1,000 barrels of oil or several tons of wheat in your garage. It's expensive, it's inconvenient, and it's logistically complex. Derivatives solve that problem. They let you trade the value of these commodities without ever touching the physical goods. Commodities also behave differently from stocks and bonds, which is why they play a big role in alternative investment strategies, especially as we head into 2025. They can hedge against inflation and currency swings, and they tend to move in different directions than traditional financial markets. That makes them excellent tools for portfolio diversification. But here's the key: you need the right tools and resources to learn. One of the best places to get started is the crystalballmarkets.com digital options platform. It's tailor made for beginners and advanced beginners who want a clean, straightforward experience. No cluttered dashboards, no confusing jargon, just a clear path to understanding futures options basics. And if you're more of a podcast person like me, then the Crystal Ball Markets podcast is an absolute must listen. They cover everything from commodity strategies to REIT, investing in a way that makes sense. They take complex ideas and make them digestible. Whether you're walking the dog or commuting to work, it's a great way to keep learning on the go. Let's touch on who actually uses these tools. It's not just big banks and hedge funds. Farmers use futures to lock in prices for their crops months in advance. Airlines use them to fix fuel costs and avoid surprises. Traders use them to bet on market direction and volatility. Portfolio managers use options to hedge risk or enhance returns. And more, individual investors are stepping into this space too, thanks to accessible platforms and better education. This is part of a larger shift towards smart diversification. As the financial world evolves, more people are exploring commodities, real assets, and alternatives. They're asking better questions and looking beyond just stocks and mutual funds. If you're serious about protecting and growing your money, understanding derivatives is becoming a must. Now, one final thought. Just because futures and options are powerful doesn't mean you should rush into trading them. Start with education. Use demo accounts. Take time to understand how margin works, how time decay affects option pricing, and how market volatility can play with your emotions. It's okay to start small. What matters is consistency and discipline. If you want to learn how to invest in commodities as a beginner, or you're wondering whether gold or stocks make the better inflation hedge, futures and options give you a deeper toolbox to work with. And don't forget, you don't have to do it alone. Use the crystalballmarkets.com digital options platform to practice and explore. And listen to the Crystal Ball Markets podcast to deepen your knowledge and sharpen your strategies. So there you have it. That was your crash course in options and futures, tools that can be as complex or as simple as you choose to make them. Thanks for joining me on this journey into the world of derivatives. I'm Sophia, and this is Financial Market Insights for Traders. Until next time, trade smart, stay curious, and never stop learning. If you found today's episode helpful, don't forget to subscribe and share it with your fellow traders and curious investors. Let's help each other grow.